So the base rate now is at 2.25% from the Bank of England, and Capital Economics expects it to peak at 5% again in Q1 2023. But hopefully we might not have to go that far with a global economy slowing down and potentially and hopefully stronger sterling following the release of the medium-term fiscal plan, with of course with the Office for Budget Responsibility forecast, which will potentially show that we are going to balance the book over the medium term, therefore giving more confidence to investors on the UK economy. Online sales volume have been in a downward trajectory since summer 2020 as the economy reopened. Overall retail spending have also decreased since spring 2021 as households have been squeezed by inflation. But despite this fall, online sales have remained elevated. If you look at the chart since February 2020, now online sales volume are actually 24.4% higher than the pre-pandemic February 2020 level. So if you also consider the latest online shares figures with regards to total retail sales, the ONS is actually showing that August we had a 25%, 24.7% share. So again, this remain elevated, particularly if you consider the pre-pandemic, this share was at around 19%. So it's still, we're still forecasting this variable to reach around 29% overall retail sales by 2025. So take-up activity now, finally. So take-up activity for units 100,000 square foot plus during the pandemic in 2020, 2021 reached 2 consecutive record years of 49 million square foot circa, and just shy of 53 million square foot in 2021. Fast forward into 2022, demand has remained strong and resilient, as shown in this chart, particularly, of course, as you see the different quarters, we reached around 31.5 million square foot for 22 to the end of Q3. In Q3, we actually saw 9.6 million square foot, which is down 12.6% when compared to Q2 this year. So, of course, again, if you look at the data for the first 3 quarters of the year, we're actually down around 24.4% when compared to the first 3 quarters of 2019. But this is understandable because you need to consider that last year we saw an extraordinarily strong demand as occupiers were actually racing to acquire space to cope with extra demand for online delivery. If we look at take up by different grades, I mean, if you look at demand by grade, occupier activity has also been extremely strong, and the reasons are threefold. So occupiers are placing more importance on a building ESG credential, equally due to strong inflationary pressures and of course, all the different issues that we've seen throughout the supply chain, etc. Occupiers are in need to gain greater efficiency at a scale. And also, this is dictated by the market. So if you look at what's currently available in the market, there is very, very little supply. So current requirements are often in need to be fulfilled by speculatively developed units or purpose-built units, if an occupier, of course, have time to plan ahead. There are some clouds over the horizon, of course, with what we just discussed in the financial market, the economic backdrop, consumer spending, occupiers under huge cost pressures. But the long-term prospects of the industrial logistics sector are unchanged. Online sales will continue to grow, particularly as the economy recovers. Will continue to drive strong demand for logistics unit, a small unit, of course. Rental growth, we just mentioned, because of everything that we discussed throughout this presentation, will remain elevated, particularly compared to other commercial real estate sector. When it comes to capital markets, of course, once there is some more stability with regards to what the cost of money is adding, and of course, when the gap between vendors' aspirations and buyers' expectations is closing, activity will recover because everything else that we just mentioned throughout this slide.
To contextualize things, so we're a £500 million company. We have 2,000 trucks. We've got 40 depots in the UK. We have 8 inland rail terminals. The fleet does about 3 million miles a week. We deliver 30,000 loads from the container ports and from retailers in the UK. And we have about 500 acres as part of the network. We have 2,500 truck drivers, all employed. We don't have any temporary agency drivers. So we've been going 21 years. So we've grown in that time. So the supply chain is resilient. It does adapt. And in particular, we're contending with the 6,000-mile supply chain from Asia. And what we have seen in recent years is ships have slowed down to consume less fuel, so more ships have been put into the loops. We've seen the pandemic sort of end production and cause huge disruption in terms of the positioning of the ships. But we've also seen the supply chain cope with enormous volumes of PPE into all the countries around the world, and it has responded. But it has been challenged, and now we have port strikes in the UK, and also we have rail strikes in the UK. And we operate 34 trains on a daily basis to our inland rail terminals. So, but what we are seeing is with the extra ships, with the slowdown in the voyages, we are seeing more inventory in the supply chain, whether it's in warehousing, whether it's on the sea, or whether it's in containers in depots. And it's moved from a just-in-time to a just-in-case, and that will continue.
Personally, I do think that there's more movement to the downside next year. Everything that we're hearing from occupiers across the board is pressure on earnings as we move into next year. We also saw a material shift in corporate occupiers being more focused on raising capital through sale and leaseback transactions, just in order to be able to strengthen their balance sheets. So I think the reality is here now that, you know, Europe and the UK is kind of going into recession, whereas kind of midway through this year, that was still a question mark. So with pressure on earnings, I think that's going to impact demand. I think where there's some exceptions is where we have mission critical facilities. So with occupiers, if they have global R&D facilities or kind of they have requirements which are mission critical to the core function of their business, then those projects will still go ahead, but they are very few and far between. Otherwise, general demand from our perspective is going to thin out next year. So that would have an impact on demand across the board, I think, and equally land values.
We'd agree with Robert to a certain extent that the land values will continue to be the pressure point release on appraisals, because we've got other inflationary pressures elsewhere with the outward yield shift, and also the dramatic increase in construction costs. So it's the area of the appraisal that's got to give. But I think when we assess it, we've got to assess it against the the pre-pandemic trajectory, because we're seeing such artificially inflated land values that it needs to be compared against that baseline. So although the percentage drop seems to be quite dramatic, actually it probably tracks more in line with pre-pandemic levels than we've seen. But I do think that it does have to be the area in which it comes down, and I think with that obviously brings opportunity. So with those that have cash and availability of capital to be able to go out there and buy opportunities, I think it's a great opportunity to do so.
I suppose whilst there's a lot of headline news about obviously the reduction in consumer spend and inflation, the wider economic picture and what consumers are facing, there's the underlying supply issue that affects the I&L sector, and that's across the piece nationally. So occupiers are alive to the fact that whilst there will be this temporary dip in consumer spending, that necessarily if they wait to take more space, it doesn't necessarily mean that it's going to be cheaper for them to do so. So they're kind of taking a midterm view on whether they're going to need that space in the next 3 to 5 years, and if they do, they may as well pull the trigger now to shore it up, because there's no guarantee that it's going to be there, because the supply demand imbalance is so inequitable at the minute.
What particular aspects of resilience would you flag in terms of the industrial and logistics market as we go into 2023, starting with Georgia?
Thanks, Jess. I think you've always got to look at the fundamentals that underpin the I&L sector, and they are unchanged. And when we come out of this storm that we're weathering at the minute, they will remain in place. And that, coupled with the supply and demand imbalance, in my view, means that, you know, we're best placed sector in terms of real estate to weather this storm. And it's whilst it's not the most positive picture at the minute, I think there's definitely green shoots on the other side, and we're in a very resilient place.
Thank you for that note of optimism, Georgia. And John, how resilient or most resilient aspects of industrial and logistics for you going into 2023?
As I said earlier, I think we're very adaptive. The supply chain is very flexible. But I think what we now may see is, as a result of the zero tolerance to the COVID pandemic in China, and the ESG agenda in terms of shipping containers and cargo from 6,000 miles away, and I think the pressure that we've had on that supply chain, I think we may see more nearshoring or onshoring of retailers coming closer to the market, and I think that could create demand for more warehousing space in the UK. That's an opinion potentially.
Thank you, John. Interesting. Rob, over to you.
Yeah, look, I think it's well placed. I think the supply demand dynamics are propping or holding up the market in a difficult time. So I think, you know, it is one of the best performers and will be and continue to be. I think key risks or areas of focus is, again, it's around the quality of the build, it's the age of the building, it's the ESG credentials, because that comes into play from the occupier demand, because occupiers will demand and require better quality buildings, but also from the debt markets as well, in terms of liquidity of credit. It's going to be much more of a focus on higher quality, newer buildings which meet those ESG credentials. So I think that's really the critical factor.
Absolutely, thank you. And Rach?
Thank you. Yeah, I think what Robert said is obviously music to our ears, and you know, we feel the same as a developer that has an aspiration to build in this economic climate. I think as the market potentially thins with those opportunities who don't have that cheap debt and aren't in the market anymore, that the supply dynamic will be an attractive one, and one that we'll want to you know, take an opportunity from. I think that also adds to the rental tone discussions that we had earlier in terms of how resilient and the measured growth that we're all expecting. And again, it comes back to that sustainability point. Robert touched on it again. It's just the consolidation, you know, aspect of it that is critical to occupiers moving forward. And new product with brilliant sustainability features is always going to, you know, come at the top of the priority list.
Brilliant, thank you. And thank you very much to our panelists who joined us today. And now over to you, Andrea, your thoughts on the most resilient aspects of industrial and logistics, and to close off the session.
Yes, as I discussed throughout my presentation, I mean, the sector is extremely well placed to weather this storm. Of course, there are some clouds over the horizon. Will make it difficult for occupiers to plan ahead. And of course, with regards to investments, it's going to be difficult to raise debt and to price assets until things settle, as has been highly commented during the panel discussion by Rob as well. So my view is the long-term prospect of the sector are unchanged. We just need to go past these bumps onto the road. And once the consumer demand recovers, hopefully over the next 15 months or so, and then of course there's going to be even a stronger demand for warehouse assets compared to what we're currently seeing now, and of course not compared to what we're seeing during the pandemic. So with that being said, I'd like to thank you, Jessica, for moderating what I thought has been a very insightful panel discussion. More importantly, I'd like to thank our panelists for joining us, Rach, John, Robert, and Georgia, and of course Len for giving us his views on the market. And finally, thanks everyone for joining us, and we hope to see you soon at our next webinar. Thank you very much. Bye.
Thank you. Bye.